How to set up a VIX futures calendar spread. Are you curious about how to set up a VIX futures calendar spread? This strategy can be an exciting way to navigate the world of options trading and volatility analysis. Let's break it down step by step. First, it's essential to grasp the basics. The VIX index measures the expected volatility of the S&P 500 over the next 30 days. VIX futures are contracts that settle to the VIX index at expiration but have different expiration dates. A calendar spread involves buying one VIX futures contract that expires in 1 month while simultaneously selling another VIX futures contract that expires in a different month, usually the following month. The aim here is to profit from changes in the difference between the two futures prices, which is influenced by the volatility term structure. Next, you need to select the futures contracts. Choose two VIX futures contracts that have consecutive expiration months. For instance, you might buy the front month VIX futures and sell the next month VIX futures, or you could do the opposite. Your choice will depend on your market outlook and the current shape of the volatility curve. Now, let's talk about market conditions. This strategy works best when the slope of the volatility term structure changes in a favorable manner. It is sensitive to shifts in implied volatility and the passage of time. Calendar spreads tend to perform better when implied volatility is low or is expected to rise. Keep an eye on the VIX index level and trends in implied volatility, as these will impact the profitability of your spread. Once you have your contracts selected and market conditions assessed, it's time to execute the trade. You will want to enter a long position in one VIX futures contract and a short position in another with a different expiration. This spread position is a bet on the relative price movement between the two contract months, rather than the absolute price direction. This strategy is typically directionally neutral, focusing on changes in volatility. Managing your position is the next step. Regularly track the spread value as it fluctuates with changes in volatility expectations. Be mindful that calendar spreads come with a cost, averaging around $100 per spread. Historical data shows that about 43% of these trades are profitable if closed at the end of the trading day. You may need to adjust or close your position based on shifts in market conditions or your own risk tolerance. In practical terms, VIX futures calendar spreads allow traders to speculate on or hedge against changes in the volatility term structure without making a directional bet on the market. They can be used to take advantage of expected increases in volatility or shifts in market sentiment. This strategy is often favored by traders looking for exposure to volatility dynamics while managing risk compared to outright futures positions. Setting up a VIX futures calendar spread involves selecting two VIX futures contracts with different expiration dates, taking opposite positions in them, and managing the trade based on changes in volatility and time decay. This is a volatility-based strategy that focuses on changes in the relative pricing of VIX futures rather than directional moves in the underlying market.